So
Let's
some
take a
things
look.
in life don't change.
Let's take
but
a look.
markets do.
Yeah.
What are we looking at? Quiet day.
quiet-
Overnight.
Quiet in the major pairs here for sure. You are seeing some continued dollar buying across a few of them.
Dollar yen's interesting. 148.5 we're up to. Do big round numbers mean anything? Is 150 just because it's 150 an inflection point? Yes and no. People tend to gravitate around big numbers, but don't put anything into it. If you looked at a forward price, again, we trade spot, a forward price would have a different price. So, but as we get back up to that big figure level, it certainly will be something that will be talked about in the news, like, oh, the yen's back above 150 again. I don't use that as a tool to, I want to be short against the big figure and then long above it. It's not a momentum indicator. But it just speaks to that crossing through a relatively larger level. Now, the first time up there, remember, the first time we got through 150 was on a road from 105 all the way up to 150.
Yeah.
That was like, oh, is this going to be the line in the sand for the Bank of Japan? Obviously, it wasn't. We went up to 162.5 and change, or 160, close to 163. It'll be interesting to see as we go into CPI tomorrow, inflation number at 7:30 our time, whether or not we test through that level, because that would kind of, as you've highlighted here, 150, the number itself doesn't mean anything to me, but what it does from tape action is tell me that we've cleared kind of a congestion area that we've seen, not only over the last 45 days, but over a little bit, kind of an inflection point previously.
Yeah.
So I think that will bring in some interest of, okay, is the dollar, was that a short-term shakeout of dollar longs, and are we in a resumptive march up, or does that become an interesting place to fade? If you still want to buy yen, i.e. sell dollars, because remember, whenever you look at a currency pair here, when you look at dollar yen, if you're buying dollar yen, you're buying what that front currency is. You're buying the dollar and you're funding that by selling yen. If you sold this pair, you're actually long yen and short the dollar. So whatever you're doing in currency pairs, in that front part is what you're gaining exposure to. You're always gaining the other side of that quote versus base currency pair. So when you think about it, and if you've looked at yen futures, they're quoted the other way around, yen versus dollar. Mm-hmm. That's why they're a different quote, but it's really just a reciprocal of one is the reciprocal of the other.
It's not even like the same thing as options prices and implied volatility, or bond prices and yield,
right,
where it's like, oh, you can get one price or one thing out of the other. Like implied volatility is kind of like a derivative price that's taken out of the options price, and obviously the options price is a derivative that's taken off of this. So it's not even that, it's literally the inverse when you're talking about trading yen futures that are yen priced in dollars, and dollar yen forex, which is literally just the inverse. It's flipped around.
And if you're a futures trader, this quote may look a little odd to you, but I'm telling you, from doing this for 40 years, the bulk of the world and the bulk of the trading community trade yen in these terms.
Yeah.
So this is, when you talk about dollar yen, if you read something in news or something on analysis or talk to anyone in the community, this is the way we quote yen.
It's easier this way, I think, right? I mean, you're looking at a market that's trading around 150 as opposed to the yen futures. I actually couldn't even tell you, is it 0.007 or is it?
You got to add more zeros.
Yeah, more zeros. Anyways,
zeros.
And it's because I haven't looked at the futures in so long. I'm looking at the forex prices. But you raise a great point. Starting to look at some of the price action piece of this is, okay, we are, essentially one strong dollar day away from 150.
Right.
Out of any of the major forex pairs, dollar yen is the one that's gotten most comfortable with 100 pip plus moves.
Right.
And so right now trading 148.70 thereabouts, 130 pips away from that 150 price. It could be, CPI tomorrow. It could be the Fed minutes today.
Right.
It could be anything that shoots this market up to 150 or takes this market back down closer to 145. You raise a really interesting point, and I love that you bring this up, because everybody looks at 150, especially before we got up here to 160. Right. Everybody looks at 150, Pete, as being some price that like, oh, if it touches it, craziness is going to happen.
Right.
And while that can be so, large institutions can have to push around money at some of these big prices, whatever. You raise this point of you can really trade both sides of this market at these big prices. Really have to stick to what you normally would do. Because the first time that we got up here and traded 150, and then the next day, if you remember, they got up to 151 and beyond,
right.
And then we came off, and then we really came off all the way down to 130. And so if you were a short-term momentum trader, you got a couple hundred pips going through 150 there. If you were a contrarian trader, this market did reverse within 24 hours or so of getting up there. And if you're a longer-term contrarian trader, obviously this market
nice correction to the downside.
Really reversed. Now, and of course, if you're a long-term momentum trader, this was a big loser for you. I do want to tighten this window, and take a look at some of the last times we got up to 150, because it's really interesting. We got up here in the fall of last year, Pete, and traded both sides of 150 a number of times.
Right.
Which again is to say, like, if you are short-term, long-term, momentum, contrarian, or anything else, whatever strategy you want, you could be right or wrong on both sides of 150. Same thing, we came back down below. Remember all the dollars selling at the end of last year, jumped right back up here in February, March, and traded around 150 for a solid month of trading, right. Both sides of 150.
Sides. And that's the key point. It gave you the opportunity to get in and out, whatever type of trader you are. And that's what we want is we want a simple product to express an opinion, something that's not necessarily correlated to our core portfolio. If we have an equity-centric portfolio, adding in FX is it's not a chore. It's an opportunity to get some uncorrelated returns if you get markets that give you two-way action. What's great is with OTCFX, SpotFX, you can scale that exposure all the way down from a few $1,000s up to, several $100,000 of exposure with capital efficiency, because there is leverage. Now, the leverage gives you amplified movement. It's so funny. I remember talking to somebody about, years ago, I don't like trading gold futures because they move faster than gold. There is a sea of people that keep all these markets in line, arbitrageurs who are doing it. What you have is a product that is notionally bigger because of the leverage that moves faster. So if you're mindful of that, the one thing that's great is if I can get capitally efficient and get smaller, that's really interesting when I add non-correlated pieces. FX is not one size fits all. You can pick the size you want, which is great. So that lets you start to engage in product in a very comfortable way. When I say comfortable is you still have leverage, but you can choose your slice of exposure you want. And that's a nice piece when you start to adopt new product. I'm not compelled to take a big bite and then figure out, okay, I've got a larger bite because of the leverage, and I look at the notional exposure, and I got to live with this. So how do I get comfortable with it? I think the journey of using leverage effectively, which is, again, capital efficiency, is best done in very small bites. And this is what's great to do. I want a suite of products that are simple. And again, you want to learn more, tastyfx is a great place to go to understand the FX markets. Really, the takeaway here is there's not a lot of complexity to these. You are getting, you're getting a binary outcome. And what I say by that, if you're long and they go higher, you make money. If you're long and they go down, you lose it. There is not a lot of complexity involved in starting to adopt these products, which is great when you're looking at a new product set. So simple, scalable, these are things we want when we look at new products. And when it still means you have to spend, you have to start to understand and adopt and start to build out some strategies, but it gives you some time. Size with leverage is always the challenge because it takes time away from you. Anything I can do to bring the size down gives me time.
Sure.
Time is an important concept.
Well, and speaking of time, we only have a couple minutes, and I want to hit a very important developing story.
Where we're going. Yeah, Kiwi. So last night they ended up cutting rates by 50 basis points, as expected. So New Zealand has brought their rate down from 5.25 to 4.75. Kiwi had kind of been on a tear with Aussie. Is this a classic a little bit buy the rumor, sell the fact? Well, the kicker was that they cut by what was expected, and the statement was they're interested in cutting more. So the market took a fair amount of gas out of this. We're sitting on the lows right now, 60.70 in Kiwi. 200-day moving average sits around 60.90. Something that old school FX traders look at is this 200-day moving average. Again, 1 out of 1,000 indicators you can use or craft. Whatever indicator works for you is great. But this is not a dollar move. This is a Kiwi move.
Yeah, and this is a heck of a move. I mean, this is getting smoked, Pete, from trading 63, above 63.5 to now getting close to 60 cents.
Yeah, absolutely. And let's take a look at the Aussie chart, because Kiwi have a high correlation to one another. Pulled back, very different pullback though. So we've seen that Aussie Kiwi pair, which is a very actively traded pair. We've seen that definitely gain some ground right now.
Yeah, look at that going back to its highs. I mean, right now trading 110.80. 111 is really the highs, just a 111 and change.
This is the exercise of, we looked at Aussie US, we looked at Kiwi US, New Zealand dollars, the nickname is Kiwi. And now we've looked at the pair, removing the dollar component, and seen a different interesting extreme.
Yeah.
That's one of the great things you get to do here is overnight, again, you've got all these different countries and economies doing different things, whether they're central banks or numbers coming out that provide you, don't get caught up in the numbers so much as the tradable opportunities around movements. And here you've got two different pairs giving you a very different story in terms of their relationship right now that creates a very interesting tradable.
Well, we'll continue to watch this New Zealand dollar because, yeah, not only against USD, but also against Aussie, some really interesting price action, some extremes in play for sure, especially in this currency cross. But that'll do it for today's show.
Yep.